When it comes to investing, everybody wants growth. And when it comes to growth, there's one word that comes to mind.
Nasdaq.
I am a believer in the Nasdaq.
QQQ is the Invesco ETF that tracks the Nasdaq 100 index. And you could say it's the Mona Lisa of growth ETFs. It's the most recognizable, the most talked about, and the most studied growth ETF probably in the whole world. But is it the best? Let's find out. So QQQ has the credentials. It's the highest rated large cap growth fund by total return over the past 15 years, as defined by Lipper, is the second most traded ETF, SPY being the first, has a 5-star Morningstar rating, and a 15-year performance against the S&P 500 that has basically crushed it. And if we look at just a basic profile for QQQ, we see that it's the Invesco QQQ Trust ETF. It's based on the Nasdaq 100 index, has a dividend yield of 0.59%, which of course, you're going to buy these growth ETFs to get that dividend yield. I'm kidding. Has an expense ratio of 0.20% and a total number of holdings of 102. And if we look at some stats for QQQ, we see the percentage of the index that's in technology stocks is 48.96%. The top 3 holdings account for 26.04% of the index, and the top 10 holdings account for 48.08%. It has a 20-year return of 14.17%, a 10-year return of 18.19%, and a 5-year return of 15.98%. Now, if you're wondering why I picked those particular stats for QQQ, we're going to compare them to the other funds just to see how they're different. Now, with every ETF, we need to understand what criteria they're using to populate the index, and that's what we're going to get into next. The Nasdaq 100 index measures the performance of the 100 largest Nasdaq-listed non-financial companies. Now, what that means is that number 1, they need to be in the global select or global market tier of the Nasdaq. Number 2, they must be classified as a non-financial company, which is basically a company that's in any other industry other than financials. They need to have a minimum average daily trading volume of 200,000 shares. They need to be trading for at least 3 full months. Also, the companies can't be in any bankruptcy proceedings or any agreements that would make them ineligible. And then all companies that are eligible under that criteria are ranked in descending order by market cap. At that point, the top 75 in that list are automatically included, and then any other issues that were already members and are ranked in the top 100 are added to the list. And once the list is finalized, then the companies are weighted by market cap. Okay, so we have a pretty good idea of what QQQ is about and how it's made up. But what about these other growth ETFs, especially the ones who seem to be outperforming lately? Well, I dug into 6 of the top 10 growth ETFs by total assets to see how they compared to QQQ. Here's the 6 we're going to take a look at. The Vanguard Growth Index Fund ETF, VUG. The iShares Russell 1000 Growth ETF, IWF. The Vanguard Information Technology Index Fund ETF, VGT. The Technology Select Sector Spider Fund ETF, XLK. The iShares S&P 500 Growth ETF, IVW. And the Schwab US Large Cap Growth ETF, SCHG. And you already got a glimpse of it with QQQ, but here's the type of things we're going to look at for each one of them. Return over the last 20, 10, and 5 years, the total number of holdings that each one holds, as well as the percent that the top 3 and the top 10 make up of the index, as well as what percentage of the index is in the technology sector. And obviously, we'll talk about the index that each one of these ETFs is tracking, as well as the actual criteria that the index uses to decide what stocks go in it. And let me tell you, in this case, it was a lot tougher than the dividend ETFs. Those were a cakewalk compared to these. But we'll see if by the end we can figure out which growth ETF makes the most sense for our own individual situations. All right, let's dive in. Up first, the Vanguard Growth Index Fund ETF, VUG. It's based on the CRSP US Large Cap Growth Index. It has a dividend yield of 0.61%, an expense ratio of 0.04%, and a total number of holdings of 238. In terms of the criteria that it uses, they start with the U.S. Total Market Index and take the large cap companies from there, which basically equals 85% of the companies by cumulative market cap. And then they score each equity to determine whether it's a growth stock or a value stock, which is going to be a common thing for a lot of the ones that we talk about. And the criteria that they're using break down like this. First, to determine value, they're using these 6 criteria. Book to price ratio, future earnings to price ratio, the 1 and 2 year, historical earnings to price ratio for the last 4 quarters, dividend to price ratio, and sales to price ratio for the last 4 quarters. And then to determine growth, they're using these 6 criteria: future long-term growth in earnings per share, future short-term growth in earnings per share, the 3-year historical growth in earnings per share, the 3-year historical growth in sales per share, the current investment to assets ratio, and return on assets. And so just starting off, it seems like a lot already, but at least up to this point, it's comprehensible. But now it gets a little bit deeper. After they Winsorize the data, they calculate cross-sectional mean and standard deviation, they z-score the data, and then they create a composite style score. Then these composite scores are then ranked, and then the ranked values are put together to get a relative growth to value score, which then determines their specific weighting in the indices. Whew. And part of what I try to do for each of these is break down all this criteria into kind of a 1-sentence description of what it means. So for VUG, what I came up with was it's large cap U.S. growth equities based on earnings per share, sales per share, investment to assets ratio, and return on assets. Okay, next up is the iShares Russell 1000 Growth ETF, IWF. It's based on the Russell 1000 Growth Index, has a dividend yield of 0.75%, an expense ratio of 0.18%, and a total number of holdings of 448. In terms of criteria, it starts with the Russell 1000, but I can break down exactly how that's happening. It basically takes U.S. companies with a share price above $1 and a market cap above $30 million that have more than 5% of their shares available. They take that list and they sort it by market cap, and then the top 1,000 basically make up the Russell 1000. So this starts with the Russell 1000 index. At this point, they take the Russell 1000, which is kind of that base index that they're using, and they apply growth versus value criteria, just like we did for the last one. But in this case, the criteria is slightly different. In order to determine growth versus value, they're using these criteria: book value to price ratio, the IBES forecast medium-term growth for 2 years, and the sales per share historical growth for 5 years. At that point, stocks are ranked by those 3 variables, and then a composite score is made up of 50% book value to price ratio and 25% of each of the other 2 growth items. Once a composite score is created, then stocks are ranked by their composite score, and a probability algorithm is applied to assign growth versus value weights to each stock. So for example, if a stock is determined to be 80% growth and 20% value, it'll have an 80% weight in the growth index and a 20% weight in the value index. Hopefully that makes sense. So for IWF, my simplified criteria is basically Russell 1000 growth based on IBES forecast and sales per share. Okay, next up, VGT, Vanguard's Information Technology Index Fund ETF. So VGT is based on the MSCI US Investable Market Index Information Technology 25-50. That's a mouthful. Has a dividend yield of 0.72%, an expense ratio of 0.10%, and total holdings of 325. In terms of criteria, VGT simply takes US equities in the technology sector weighted by market cap. They can have no more than 25% in one single stock, and the sum of all stocks that have a weight greater than 5% can't be equal to more than 50% of the index. And that's it. That one is super simple, actually. So my simplified version is U.S. equities in the technology sector weighted by market cap. Basically just what it says. Next up, the Technology Select Sector Spider Fund ETF, XLK. XLK is based on the Technology Select Sector Index, has a dividend yield of 0.81%, an expense ratio of 0.10%, and total holdings of 68. In terms of criteria, it takes U.S. equities that are in the S&P 500 within the information technology sector, and then they're weighted by market cap with no more than 25% being able to be into one stock, and the sum of all stocks that have a weight of greater than 5% can't be equal to more than 50% of the index. So it's basically the same type of thing as VGT. The only difference is that XLK only includes technology stocks that are in the S&P 500, whereas VGT takes all U.S. equities that are in the technology sector. So the simplified version is U.S. equities in the S&P 500 within the technology sector weighted by market cap. Next up, IVW. IVW is the iShares S&P 500 Growth ETF. It's based on the S&P 500 Growth Index. It has a dividend yield of 0.89%, an expense ratio of 0.18%, and a total number of holdings of 237. In terms of criteria, it starts with U.S. equities in the S&P 500, and then it measures growth versus value based on the following criteria. For value, it uses book value to price ratio, earnings to price ratio, and sales to price ratio. For growth, it uses the 3-year net change in earnings per share over the current price, the 3-year sales per share growth rate, and momentum, which is basically the 12-month % price change. So for IVW, our simplified version is U.S. equities in the S&P 500 Growth Index based on earnings per share and sales growth rates, plus 12-month price momentum. And last but not least, Schwab's U.S. Large Cap Growth ETF, SCHG. SCHG is based off the Dow Jones U.S. Large Cap Growth Total Stock Market Index. That's a mouthful as well. It has a dividend yield of 0.45%, an expense ratio of 0.04%, and total number of holdings of 245. In terms of criteria, it starts with U.S. equities that are sorted by market cap, and then the top 600 go into the large cap index. At that point, any current companies are added back until the list reaches 750. And that 750 is basically your large cap U.S. stocks list. At that point, they determine a growth versus value score by the following factors: projected price to earnings ratio, projected earnings growth, price to book ratio, dividend yield, trailing revenue growth for the previous 5 years, and trailing revenue growth for the previous 21 quarters. Each company is ranked by each of those factors. Then the 6 values are Z-scored for normalization. See, we're just Z-scoring and Windsorizing and all kind of stuff. I'm sure if any of you guys are like actual like stats guys, you're probably like, this guy's an idiot, but it's okay. And then a cluster analysis is done, and then they're given a style score, whether they're growth versus value, and then whether a company is growth or value depends on where it lands compared to the style midpoint of the data set. Cool. So for SCHG, our simplified version is large cap U.S. growth equities based on projected earnings growth and trailing revenue growth. So now that we have an idea of what each fund is about, let's take a look at the stats for the group and try to compare some numbers a little bit. So as you can see, I created a little spreadsheet here with all the different ETFs and a bunch of their information and stats. A few of these things we've already talked about, like dividend yield, expense ratio, and number of holdings. But let's talk about some of these other things to get an idea of how they stack up against each other. So if we look at return, we can see that in the 20-year return, actually the best one out of all of them is QQQ. And when we start to look at the 10-year, then you can see that VGT and XLK are actually the top performers. Now, if you remember, VGT and XLK were the technology sector funds. And all the rest of them kind of are lagging behind a little bit in the 10-year, except for QQQ. It's a little bit behind, but it's still in that upper tier. Then if we look at the 5-year, we can see again, VGT and XLK are the top performers. Technology has definitely outperformed over the last 5 and 10 years, right? So it makes sense, especially when you understand that they're made up of companies like Apple and Microsoft. Those companies have done extremely well over the past decade. And if we dive into the holdings a little bit, we can see the differences in diversification between the funds. And if we look at percentage technology, we can see XLK and VGT are 100% or basically 100% because that is literally the criteria they're using in the index to determine what stocks are going to go in the fund. Technology stocks. But as you can see, even QQQ is almost 50% tech. And most of them are, except for IVW, that's a little under 36%. Now, if we look at what percentage of the index the top 3 holdings and the top 10 holdings make, it gives us an idea of how concentrated each one of these ETFs are in particular companies. So for instance, if we look at VGT and XLK, we can see that they're almost 50% made up of the top 3 holdings. And for both of these, they have the same top 3 holdings: Apple, Microsoft, and NVIDIA. What that means is that half of your money in this fund is in those 3 companies, which you might be totally fine with, or you might not have even known. But if we look at a few of the others, QQQ is there at 26%, which is really interesting because they've gotten really good returns, but they're one of the least concentrated ones on the list. And you can see that concentration even more when you look at what percentage the top 10 holdings hold in each of the ETFs. Like XLK is a whopping 69% in their top 10 holdings, whereas VGT's over 60%, But then IVW is less than 50%, as well as QQQ. And so what this is starting to show is how these ETFs are slightly different. So even though we can look at past performance, we always know it's not a guarantee of future results. But what we want to get out of this is understanding what's actually in these ETFs a little bit better, so that based on what you think is going to happen in the future or what you're most comfortable with, you can choose the right one. And so what I did was create this sheet that basically takes in the elements that we've looked at and tried to put them in some kind of easy to consume format. I basically have the fund, the name, the index that it follows, all that's just basic information. Our simplified criteria that we used from before is all in there, so I can get a quick look at how the criteria is different compared to each ETF or how much it may be overlapping. And then a very basic and simple grading of their diversification between their sector and their holdings, as well as their past performance. And so when you look at past performance, XLK and VGT have been the best ones, but they're also the most concentrated because they're heavily weighted into tech and more specifically, heavily weighted into 3 particular companies. So as investors, the question we have to ask ourselves as it relates to VGT and XLK is, do you still want to be overweight and concentrated with Apple, Microsoft, and Nvidia? Do you believe that that's going to continue on? And if you do, then those might be a really great choice. They've obviously performed well over the past 5-10 years and outperformed all the rest of these. Or the flip side of that is if you think that tech is a little bit overpriced right now and you want a growth ETF that has a wider distribution of sectors and maybe companies that it invests in, then you might shy away from those two and look at some of the other ones. Obviously, the one with the most diversification is IVW. But IVW was also pretty much the worst performer out of all the ones that we looked at. So it's a question of, if you really believe that diversification is your top priority, then it might be the best growth ETF for you, knowing that it may not outperform the others, or if you assume that because it's the most diversified and the other sectors are now going to outperform tech, that it will actually outperform in the future. But at least you can make that decision knowing why it's different. And actually just looking at the differences of these, I think it's a really great case as to why QQQ is such a popular growth ETF. Because even though it's just average at sector diversification, it's actually in the best tier in terms of holdings diversification. Because its top 3 holdings only made up 26.04% of the index, and the top 10 are still under 50%. And when you look at past performance, QQQ was the only one that was in that top tier that wasn't a technology-specific fund. And so while it didn't quite match up with VGT and XLK in the 5 and 10 year, it actually outperformed them in the 20 year. So basically, you're getting close to the best possible returns within this group in a fund that's way more diversified than the other 2 that have been outperforming. So even though I was kind of joking at the beginning, QQQ may actually kind of be like the Mona Lisa of growth ETFs. It may not be the best at any one thing. It may not have the best returns in any one year, but it gives you amazing returns in a more diversified way. So as the macro environment changes, as companies change, as different sectors outperform, you have a better chance of continuing that outperformance because it's not just tied to one sector or a few companies. So hopefully this breakdown helped if you guys were looking at growth ETFs, and at least gives you a little bit more information so you can make a decision that happens to fit with what your goals are. Now, for me personally, I actually think QQQ is the most interesting one that happens to line up with what I'm most interested in. But of course, for you, it might be something different. Hope you guys have a great day out there. Financial independence is true freedom, so keep building, stacking wins, and I'll see you guys in the next one. Peace.